All right, we'll turn the recording on now with everybody. See, look, this is the great thing about having a live class. I mean, think about all the professors that record these classes and use them for seven years, right? They never get to know anything about their students. So I'm incredibly happy that we get to do this, and I'm incredibly happy that you guys get to join us as often as you do. So thank y'all for coming in. A couple of y'all were supposed to remind me of stuff. What are y'all supposed to remind me? Because I forget stuff. Do y'all remember what y'all were supposed to remind me of?
I think it was Jawan was supposed to remind you about something,
And Juwan's not even here.
but I forgot.
Y'all forgot
I
what
didn't
Juwan
And I
remember.
was supposed to remind you of something that Katie said, but I also forgot.
Well, hell, y'all, what good are y'all? Oh my
None.
gosh.
I am
Well,
worth nothing.
No. Yes, you are. We'll figure something out. We'll figure something out. First of all, let's talk about our boy Warren here. So let's talk about this, right? So you guys had to do the Warren Buffett thing and you read this. So you've done your discussions, everyone's done your discussions. So let's go with Nick. Nick, you got a bite in your mouth. You can get that out before you don't spit all over your screen or anything. Okay, drink the coffee, got it down. All right, so Nick, what was your take on Warren Buffett and what did he tell us to do? And do you agree with him? Do you disagree?
I would say I agree with him because he does it so well. So like with my stock recommendation, I just chose his company. It's too difficult to understand I would say like the actual stock pricing without like what he does is just buys huge stakes in the companies to hold them. And so the average investor is not going to have that like knowledge to pick stocks. And so they should just go with the market. And so I kind of, I agreed with him, although I think everybody who wants to invest wants to have that like side play money where you're like, ooh, I picked this one and it did good. And it's like a little pride of like, you did something good, but for the bulk of your investing, I think he's very right.
Okay. Yeah, because my thing was, I said that I argue that you should never buy stock in an individual company. Never. So my daughter is 18. So she graduates high school this year. And she had her little dishwashing job at the local Greasy Spoon. And so she made a little bit of money. And so what we did is, guess what? Give away how much?
10%,
Save how much?
10%, minimum 10%,
Invest how much? 10%.
minimum 10%.
Yeah. So we opened her up a Roth IRA at 18 years old at Vanguard. And guess what I had her put it in? VOO. Do you want to know what VOO is at Vanguard?
The S&P ETF.
So the S&P 500. And I said, do the S&P 500. And I said, don't ever look at it. Every time you get a paycheck, 10% goes in there. Every time, 10%. Every time, 10%. Open it up when you're 60 something. Now, is that a little bit aggressive? And I even told her, I said, if I were to, pass away and like Isabel's song, I'm 6 feet under, I'll come back and visit you if you're not putting 10% in there. Now, am I crazy? Does she need something else? Does she need exposure to small cap? Does she need exposure to gold and currencies? Does she need oil and natural gas? No. She's 18 years old. She needs the S&P 500. And she needs that for a good 30, 40 years. And she's going to be just fine. Now, some would argue, and maybe some of you would argue, but Bobby, that's the 500 largest companies in the United States. Don't you need international exposure? International hooey. Who needs international exposure? Are you telling me Apple, which is in the S&P 500, isn't an international company? Are you telling me that Microsoft is in the S&P 500 is not an international company? Are you telling me that Tesla only sells cars in the United States? Phooey on international exposure. So goes the 500 companies in the United States. So goes the world. Now, am I a little bullish on The United States, well, maybe so. But here's what I would say, right? So 500, we are let's talk about our country and how it was founded on. Our country is the United States of America, the old great US of A. It is for the blank, of the blank, for the wait, let me do my writing. For the blank, of the blank. What's the third one? For the, y'all know what I'm talking about? Where does this come from?
For the people, of the people, by the people.
Okay, by the people. That is wrong. Would anybody else like to, it is not for the people, of the people, and by the people. Isabel, was it you that said that?
No, sir, but
Who
that's
said
what.
that?
Me, it's for the dollar.
It's for the corporation. It's of the corporation. And it's by the corporation. Y'all, convince me that I'm wrong. And you can be anti-corporation all you want to, but I hate to tell you, they're the ones buying the politicians. It's not going to change. I don't care if you're a Democrat, a hypocrite, a Republican. I don't care what you are. I don't care if you're a Green Party. I don't care if you're a Tea Party. I don't care if you're a Libertarian. I don't care. It's all, this country is for the corporation, of the corporation, and by the corporation. Now, we kind of say it's for the people, of the people, and by the people. It's not. It's all about the corporations. And the corporations are going to be just fine. Trust me. It doesn't matter if Nancy Pelosi is Speaker of the House. It doesn't matter if Biden is president. It doesn't matter if Trump is president. It doesn't matter who's president, who's whatever. I'm telling you, they're all for the corporation, by the corporation, of the corporation. And in my book, me owning 500 companies, the 500 greatest companies in the United States of America, is the horse that I have attached myself to. Ladies and gentlemen, I retired at the age of 51. From my earliest days in college, I worked for the federal government in the United States judiciary system, even when I was a little college kid. And do you know what little Bobby did every week, every 2 weeks that I got paid? I put my money in the C fund. Anybody know what the C fund is with the federal government? It is the S&P 500. And I did it month in and month out. And if I got a raise, that percentage went into my little 401k, or it's actually thrift savings plan. I did it through recessions. I did it through 2000, the dot-com bubble. I did it through the 2008 financial crisis. I did it through COVID. I did it through everything. And I turned out all right. I think in your lifetime, your children's lifetime, and your grandchildren's lifetime, if there's one thing that I can tell you, the American corporation will be strong, because capitalism allows the free flow of money to those areas that allow free thought and free enterprise. Now, are there other areas of the globe that are open and maybe more open than the United States? Yes, but I'll tell you, as far as the where was Elon Musk born? Anyone know where Elon Musk was born?
South Africa. Right.
It was in Africa somewhere, right? He was born in Africa. I forget exactly where. And all of a sudden, where is he now? He's in the United States. Why is he in the United States?
Or the corporation, of the corporation, by the corporation.
That's where you want to be. I mean, it truly is. You know, even, I mean, you know, now, yeah, I think the world's richest person is from France or something. But the vast majority of your billionaires are where? The United States. Why? Because their enterprises are able to flourish in the old US of A. Now, you can certainly disagree with me. And you can say, okay, Bobby, I'm going to put my clients in, you know, if they're 90 years old, I'm not putting them in the S&P 500. I got that. But I'm talking for most of you. Most of you are in your 20s and your 30s. Where should your money be? It should be by the corporation, of the corporation, and by the corporation in some shape, form, or fashion. I would much rather see you diversified in 500 companies rather than you picking 5 stocks that could go bankrupt. Now, let me ask you a question. Tesla is a member of the S&P 500. What happens if Tesla goes bankrupt? What happens to the S&P 500? Does it become the S&P 499?
They're gonna replace it.
They replace it. It is self-cleansing. So if one falls out, you're left with 499 and they're going to bring in the next up and comer. Now, here's why I don't want you to be at NASDAQ, which is the QQQs, right? Or /NQ for the futures. How many companies are in the NASDAQ? When you hear on the radio, you're driving down the road and they said, NASDAQ was up 200 points today or whatever. How many are in the NASDAQ? Anybody know? We got 500 in the S&P 500, which actually may be 501 or 502 because Google's in there maybe twice. I don't know, but around 500. How many's in the NASDAQ? Anybody know? Just take a guess.
Isn't it 100?
100. Actually, it's like 102. But yeah, it's the NASDAQ 100. Very good. Who said that? Was that Nick? I'm watching you, Nick. Got my eye on you. All right, so 100. All right, now, most of the time, if you're watching your local news and they give the stock report, they always talk about the Dow. The Dow was down 700 today. How many companies are in the Dow Jones Industrial Average?
30.
30. Who said that? Shannon?
Katie.
Katie. Katie, I thought you weren't going to be here today.
I didn't think I was gonna make it either, but I'm here.
Well, I'm so proud you're here, girl. That's good. Okay. Katie canceled whatever appointment she had. She said, screw y'all, I'm going to Dr. Gaines' class. Okay, we appreciate that. That's dedication. Katie, send me a message, you get an extra point. Nick, send me an extra point. You get an extra point as well. Have I given everybody their extra point so far? If I haven't messaged you back, that means I hadn't got it. All right, so send me a message. Say, give me an extra point. I'll give you an extra point. So it's self-cleansing, y'all. It's 500, and I've told you why I don't think you need diversification, because the 500 largest companies in the S&P 500 do business international. To me, it's the perfect place for my 18-year-old daughter to put money in for the foreseeable future. I see her going all the way through her 40s in the S&P 500, and I can imagine the incredible wealth that my daughter will build if she'll only continue doing that, okay? So when you hear on the local news, the Dow is up 700, will you call those losers and tell them nobody cares what the Dow did? It's 30 companies. And there's only one company that is in it from when it was originally started. Anybody know what that company is for a extra point?
General Electric,
Who said that?
Evan Jackson.
Evan. Absolutely. Evan, send me a message, email, you get an extra point. That's great. There's 30 in there. Very, very good. All right, so very good. So everybody realizes why I say the SP 500 and that you can't pick stocks. Jawan, you were supposed to remind me of something today, and we were all bad-mouthing you. Isabella, a while ago, she was like, that Jawan was supposed to tell you something, he skipped class. I was like,
Yeah.
Isabella, don't talk bad about Jawan like that.
Well, Isabella, to my defense, I got stuck on a call with a client, so I wasn't able to join in at 2:30, but I was actually raising my hand to ask you that question while we're on the topic.
Oh, wonderful. So what were you supposed to remind me of? Because we all forgot.
Yeah, I was supposed to ask you, so during the COVID-19 pandemic, you mentioned that you received about a 208% return on your investments, and you wanted to talk to us about that.
So let me tell you about that. I did what is called a put-back ratio spread, and I did tons of them. And I did them in the E-mini S&P 500. And so I put on these things, and a friend and I had talked about doing this trade as a put-back ratio spread. So I'm going to show you what I did, okay? Now, y'all, this is going to be a little technical, but if you'll just stay with me, all right? So I went into the E-minis, and this is the future of the S&P 500. So SPX is the S&P 500. This is the future. You've heard of futures before, the S&P 500. And here's what I did. I went out to 90 days, and I sold 3 puts. Let me show you how I did it. I sold 3 puts at about 90 days. So let's go here. And I sold a ton of these. So let's say that I don't even remember how many I put on, but let's say I sold 30 of these. I had a bunch of them, probably more than these. So I sold 30 puts. Is that a bullish or a bearish play, y'all? Does anybody know?
Bullish.
It is bullish, right? So I'm selling puts. If I bought puts, that's bearish, but I sold 30 of these. So let's analyze this trade so everybody can see it. Check this. You're going to like this. So I sold 30 puts. Go to the Analyze tab here so you can just see what the risk graph looks like. So I sold 30 puts, or some number. We'll just make it up. So the risk graph of selling 30 puts kind of look like this. Let me just get it where you can see. And we'll talk risk graphs later, but let's see if that'll populate actually. Yeah, here it goes. This takes it a while. So if I sold 30 puts and price stays right here, I make $4,500. If price goes down here, I make $4,500 by April the 29th. If price goes down here, I make $4,500. I mean, price, you know, if price goes down 20%, this is my 20% line, I still make $4,500. If it happens today, I lose $50,000. If it goes down, here's my break even, right? I lose $307,000 today. But if it expires here, I make $4,500. So it's a very, very, very bullish trade. But then I took the money, that $4,500 that I brought in on the 2,500, and then I bought 60. So I bought 50. I bought 50 puts in the 60-something day expiration at the 24.50. Let's see if we can find those. Y'all like these. So COVID, so I went in about 30 days. So I went here at about this 66 and what I say, 24.50. And I bought 50 of those. So let's change this to 50. And I forget the exact number. It was a ton of them. All right, so 50 of those. So let's analyze that trade, see what it looks like. So analyze trade. Now, so that cost me a little bit of money. I sold 30 of these for $3. I bought 50 of those for that. And let's just see what that looks like. So that looks like if the market, oh, I don't have all my price slices set. Oh, here I do. Trying to make sure I show you what I did. Yeah, so this shows that if the market went down 20%, that I made $3,000, right? $3,000. But that doesn't take into effect what volatility was. And volatility was really big at the time. So what happened is the market went down. Overall, I think it was 35%. So I'm going to put this price slice. See this slice here, which is the yellow vertical line. And this is a little over your head now. It's a little technical, but I just wanted to kind of show you what happens. So what happens is it shows you that on my little investment that I put on in January, that if the market went down 35%, I made $69,679. Yay! For old Dr. B making the money. But what you don't understand is that volatility increased so much that, look at this. I want you to follow these lines over here. Let me draw a box so you can see the little box. I want you to watch over here. These are various levels of volatility. So if volatility went up to, I think it was 80 something. Let me bump that up. Volatility went up to about 80 something percent. So we'll go for that between 243,000 and 301,000 on my little bitty options play. Now, isn't that cool? So I was up over 208% in one day. Now, here's the funny part of the story. I was eat up with the diabetes. And for those of y'all that may have diabetes, my apologies to you. So what had happened was I had as many diabetics have, I had an issue with my foot that caused an infection to get in my foot, and it had got into my bone. So I had an emergency visit to my podiatrist on the day that the market was crashing. He has informed me that I must get my toe amputated. That's why I told you before I've got 9 toes. Cat has 9 lives, like Puss in Boots that we saw over the weekend. I got 9 toes. So I'm sitting in his chair and I'm like, he's got a sign in there that says no cell phones. I said, Doc, you ain't gonna believe this. The market is crashing because of COVID, and I've got to close some positions. It's kind of an emergency. He said, oh no, I bet you lost a lot of money today. And I just smiled at him and I said, Doc, you may be taking my toe off, but I made more than enough to pay for this operation. It was one of the greatest days ever. I never had 208% return on my entire account in one single day. So I tell you that story, and he ended up cutting my toe off. So I did want to tell you that because I want you to know, with options and with futures, there are some very, very fun things that you can do and structure these things so that if you have knowledge of an impending doomsday event, that you can actually profit from it. Now, a lot of technical stuff that we went for here, I don't expect you to understand it all. I just want you to know that I constructed a trade that made a ton of money in a single day. All right, questions about that at all? Now, I think somebody was also supposed to tell me. Okay, first of all, one more person with, let's talk about one more person with Warren Buffett before we move on to someone else. Isabella, can you talk to me about Warren Buffett and what your take was on it?
Sure. So I kind of agree with you. I think younger people definitely should get in the S&P 500 index funds. But kind of with what Jawan was saying and kind of what I put in my discussion post was, I think you need other stuff in your portfolio. And I think a lot of like the whole S&P 500, how it's going to benefit you comes down to like timing and like unique personal things. Like if the market went down like it did in 2008 and you were close to retirement and most of your money was in S&P 500 index funds, that would not be good at all. So I just think you need to really be aware of like where you're putting it and when you're using it. But I think it is a good tool to have in your portfolio.
Yeah, and what you'll find is the more stuff that you put in your portfolio, you may be more diversified, but the less returns that you're going to get. And that's what I told my daughter. She says, I want Tesla in there. I said, you got Tesla. She says, well, I kind of want Apple in there. I said, you got Apple. You're kind of diversified over 50. And Isabella is right. The closer a client gets to actually needing the money, maybe that's the time that we pare down, right? Because it would be terrible to have a 35% down move in the market like we did in 2020 at the time of retirement when you need the money. So I totally agree with that. All right, anybody that just hates the S&P 500 deal, just hates it, just think it's horrible, it's okay to disagree with me in this class, by the way. I don't take it personally. Okay, good. So I'm glad that you guys got that at least. Okay, now let's talk about our readings. All right, let's talk about debt, the unacceptable burden in the Simple Path to Wealth. Everybody reading your book? I hope you're reading your book. I hope you're getting to it. Who was it that told me that, hey, you loved it so much that you were like 10 chapters in before you knew it or something? Someone told me that. That was kind of good, right? Shannon, did you enjoy it that much? She's laughing at something. What's wrong? Tell us, Shannon, how has the book spoke to you at all?
It makes sense. I mean, a lot of the things I learned the hard way, so totally makes sense. But yeah, I'm almost done with that one.
Good. Y'all, making money and building wealth is simple. It's really simple. It's just not easy. Building wealth is simple. It's just not easy because people will go into debt, which is the unacceptable burden. Don't pile yourself up with debt. If you're about to graduate from college, please do me a favor. Don't go into debt and buy you a new car just because you got your first job and you're gonna go into debt. Just don't do it. Now, tell me some dumb types of debt. Katie, you know, give me some dumb debt. Dumb.
Credit card.
Credit card debt. Some of y'all are buying stuff to, you know, like we said, the Dave Ramsey things. You're buying stuff with money you don't have to buy things you don't need to impress people you don't even like. Do you realize how liberating it is if you don't give a crap what people think about you? Oh, y'all, listen to me. Maybe it's because I'm old. I'm 52 now. I know you're thinking, Bobby, you look 28. I know. Hey, I got it. But the thing is, I'm 52 now. And the older I get, the less I care about what people think of me. My wife will say, are you honest to God going to wear that out? I said, oh, yes, I am. You doggone right I am. I don't care. I don't give a rip. And then she'll say, well, what do you care? Don't you care what I think? And then I'll go, yes, honey, I care what you think. So I'll try to, you know, make Beth happy. But yeah, it's the unacceptable burden. Debt, you don't need it unless what? What is some good debt? Let's talk about good. We talked about bad debt. Is car debt good debt or bad debt? Car debt, good debt, bad debt.
Bad debt.
Yeah, some of y'all are driving cars that you ain't got no business driving. You say,
Can
well,
I-
Bobby, yeah, go Juwan.
I was gonna say, can I challenge that a little bit?
Challenge me, baby. Come on.
So would it really only be considered good and or bad debt depending on what your financial situation is? Because like, for example, financial situation as well as interest rates and return that you're getting on the interest rate. Because for example, my husband and I recently just did a big project and we put it on an IKEA project card because we get 0% on, you know, X amount for 12 months. And so instead, we put all the money aside, we have it to pay off completely, but we put it in a high yield savings account to be able to get nearly a 4% return on there while paying 0% interest and continue to make the monthly payments. So in that example, would that be considered, even if you have the money aside, but it's more advantageous for you to hold on to it while still making the payments that you need to stay in good debt? Would that then make that a good or bad debt consideration?
Juwan, I would say your situation is the exception, but not the norm. Right? So what is your, do you mind me asking, what was the project?
Yeah, so we are in the process, we bought a house bought a townhome last year, and we are in the process, we just built a media wall that took 2 days from scratch. Lots of wood and things all around the house. I was very excited to get that cleaned up, as well as we're about to build a guest rental suite. We're cutting our garage in half and turning that into a suite for family and then kind of some passive income. So that being said, again, the money is there being set aside to be able to prepare for the projects. And yeah.
Juwan, what you have just described to me is constructive debt. It's constructive debt. You're building an extra suite that's going to produce income and is going to allow you to have family and friends that can come stay with you guys, right? I think that's fabulous. You created a media room that gives you joy within your home that actually increases the value of that real estate. I say that's constructive debt, especially if you've set aside the cash and you're earning a higher interest rate on it than the zero interest that you got. But you got to understand, that is most people can't do that, Juwan. You understand that what you and your husband are doing is something that is unusual, right? It's unusual because most people don't have the discipline to do that. So I would call that constructive debt. Now, if you guys went out and said, hey man, let's go buy a Ferrari, put a couple $100,000 on, no, I can't see that, because what you're doing is you are paying interest or financing something that is going down in value. You're paying for something that goes down in value. You are financing something that is increasing the value of your home and that is actually going to provide another source of income. Kudos to you. Yeah, you both did a great job on that.
So,
All right.
thank you. So then when looking at things that would normally be considered bad debt, if you are structuring it in a way that it isn't in the long run helping you, would then that still be considered bad debt?
Yeah,
That's really my
if it's detrimental to you, for example, real estate debt can be detrimental if you're buying too much home. If you're buying a bigger home just to keep up with the Joneses, right? then that's not good, right? You maybe can't afford that. You don't realize that, hey, with bigger homes come bigger problems. There's bigger issues, there's bigger upkeep. So yeah, most of us could do with much smaller homes than we are dealing with, especially if you are in where a lot of you guys are in that wealth accumulation stage, right? So wealth accumulation, there's wealth preservation, and then there's wealth distribution. And we'll talk about that later at some point. Most of you are in your wealth accumulation age. What your decisions are now is going to play a big impact on how much wealth you're ultimately going to acquire. But all of you are your own little wealth managers, right? We may not all have Katie's certifications behind her name, right? But Katie knows I'm picking her. We may not have all the certifications that Katie has, but we're all wealth managers. You're all hedge fund managers already. If you have any account, any investment account, you're already managing your stuff. So what I'm trying to tell you is manage it wisely. Manage it wisely. All right, so some of y'all didn't like the FU money. Why do you need FU money? And what did we say? Someone come up with a good other alternative word so it's not so.
I called it run money.
Run money. Now, why is it run money? Is it fun money or run money?
Run, RUN.
Okay, run money. How do you get that, Katie?
When I started a career, I was in banking, and we always would set aside an account. More so for young women, so that they would never have to be dependent upon a husband. And so it was run money, but if you take it with the FU money, it's the ability to run from whatever job is undeserving of you.
How many of you are miserable in a career, but you can't leave it because you're dependent upon the income? How many of you can't walk into your boss's office and say, screw you, pal, I'm out of here, right? Because you need that money or that income, or you can't pursue the things that you want to do, right? I mean, we talked about Juwan. Juwan loves dancing. He loves ballet. We want to get him to a point that he can do that as often and as much as he wants to do. Well, he doesn't want to do it anymore. Okay, I got you. He's giving that up.
Knees and back says otherwise.
I got you. But you understand what I'm saying, right? Do you know how liberating it is for me at 52 years old? My wife and I go to posh restaurants. I've showed you before. I mean, we go out and we spent $26.20 today at including the tip at Waffle House. And you know what we did? We both went and met with our personal trainer today at the gym. And then we come back, and then, I take the kids I get to go to all their ball games and all their practices and all the dance recitals and everything. And I don't miss anything. Isn't that great? And that's where we want you to be. We want all of you to have that freedom so that you can do the things that you want to, the run money, the fun money, the FU money, whatever you want to call it, so that you can do those things and not be a hostage in your life. You don't want to be a hostage. You want to be a wealth accumulator. At where you are in most of your life stages, you are wealth accumulators. At some point, you will become wealth preservers. And then when you die, you will be wealth distributors. And maybe even before you die, you'll start distributing that wealth to others. So those are the three categories of wealth. Most of you are in the accumulation stage. You will eventually become in the preservation stage. Ultimately, you must distribute it to your heirs or distribute it to yourself, right? Now, can everyone really retire? And I love what Katie said. Hey, the women needed to have this money set aside. So if they were in a bad relationship, they could get out of a bad relationship. If they were in a bad marriage, they didn't have to depend on their husband, right? To say, I couldn't leave. Do you know, now my daddy had a lot of bad issues, y'all. He had a lot of problems. He did. He was a troubled son. I mean, he was good at times, but there was probably more bad than good. I don't know. It was a horrible, I mean, we had good times and we had a lot of bad times growing up. One of the things that my daddy did that just killed me is he wrote a letter and he left it on the thing. And he basically was a letter to my mama saying, hey, I found someone else and I'm leaving. And my mama was devastated. And my sister and I were crying. Daddy left, he ran off with another woman. It wasn't 2 weeks later, Daddy was back. And here's what I told my mom. I said, Mama, don't take Daddy back. I said, he did you so bad, he's just going to end up hurting you again. Do you know what my mama said? She says, we can't make it without his income. So she took Daddy back. Did he ultimately do more bad stuff? Yeah, he did. So when I got out, I did a lot of real estate deals back in the day, and I bought this nice little house. Daddy was still doing weird and groovy, unruly stuff. And this is after I'm an adult married. And I told Mama, I said, Mama, I've got a nice little house that we just bought. Would you like to live there? I'll get you out of this situation with my daddy. And we moved Mama out. The happiest thing we've ever done. Got her away from Daddy. And I said, Mama, why didn't you get away from him many, many years ago? She said, I didn't know I had a choice. She said, I really didn't have a choice. We were dependent on his income. You never want to be dependent on someone else, on their income. You don't want to be dependent on that person. You want FU money, run money, fund money, whatever you want to call it, so that you are a slave to no job, that you're slave to no person. Number 3, chapter 3. Can everyone really retire a millionaire? Who'd like to discuss this? Can everyone really retire a millionaire? Evan. Evan, can you retire a millionaire? Yes or no?
I think everybody's got the potential. I just don't think everybody's willing to do what that takes, where they make a mistake or, so I don't think everybody will, but everybody has the potential to do it.
It was Jesus himself that said this. He said, I'm only going to be with you for a short time. But then what did he say? He said, somebody's going to be with you all the time. Do you know who he said that will always be among you? Shannon said it. I read your lips.
The poor.
He said, hey, I'm only going to be here a little while. He said, the poor will always be among you. It doesn't matter what social program you do. It doesn't matter what social program. It doesn't matter who is the president, who is the Congress, or who. If we tax the billionaires by 70% of their income and distribute it to the poor, I believe what Jesus said, the poor will always be among you. Everyone has the potential to retire a millionaire. They just don't have the capacity to do it. You could give everybody in the United States $1 million. What would happen to the price of goods if everybody got $1 million today?
It'd be like in Jamaica. It'd be all inflated.
Everything would be inflated. Yeah, I've been to Jamaica. I got offered some of those wacky weeds while I was walking down the streets. I know all about it. Yeah, it'd be like, yeah, you're exactly right. Everything would double or triple or quadruple in price. And guess what would happen within a couple of years? There would be as many poor people as there are today. You just can't get rid of it, y'all. It's something you can't do. And I believe in helping the poor. I believe in making sure people have clothing and shelter and food. I love that. I love that a lot of you contribute to your communities and you help people out and you do charity work and you serve in soup kitchens and all of that's good stuff. But we cannot push everyone into retiring a millionaire. It's just not going to happen. But there are 15 of you in here today and there's about 49 of you in this class. There is not a reason on this planet that all of you in here should not be able to retire as a millionaire. Every single one of you. All right, how do you think about money? A lot of people will say, we'll go back to the Bible again, right? They'll say, oh, money's the root of all evil. Is that what the Bible says about money is the root of all evil? No. What does it say?
The love of money, 1 Timothy chapter 6, verse 10, the love of money is the root of all evil.
The love of money is the root of all evil, right? It's not money that's evil. So what are your perceptions on money? Money is something that probably you thought a lot about as a kid when your mama or daddy would say, we don't got the money to buy that. We don't have the money to buy that. and you live from a principle of scarcity rather than abundance. Who would like to share their views on money and how you were shaped when you were a child? Anybody that's willing to share that? How did you growing up affect your views of money?
I'll share.
Okay, good.
My mom, of course, is a penny pincher, and she was extremely open with us about money and where expenses were. And then my dad, a few days after I turned 16, the plant where he worked was closed, and he was one of the very fortunate ones that was able to retire. But we saw the difference in some friends that we had whose dad was a year shy of retiring, and how having a little bit of security helped us with our family, but also the way that my parents managed spending, it wasn't frivolous. It was, hey, we'll do a few things so that way you weren't wanting for everything. You did satisfy a few wants, but not all of them. And that kept us all in check with what we could do. But then the other family, they just spent all the time. And then to see what's happened to them and what's happened to us, if used properly, we look at it as a tool. And they didn't use it properly. And unfortunately, that left a lot of wants on their plates because they didn't satisfy anyone. I mean, they satisfied all wants. We only satisfied a few. And one of them's he's already overdosed and passed just from spend all the money because you get it. It doesn't have to stay anywhere. So a good tool just to do a little bit now, but take care of yourself a lot later.
Good. Yeah, thanks for sharing that. That's good, Katie. Yeah, how do you think about money? I grew up from a principle of scarcity where money was scarce, and I've had to retrain myself to think about money as a tool. I come now from a place of abundance rather than a place of scarcity. So really think about that. Think about the way you think money. It's not evil, y'all. People that have money are not evil, right? They're not evil. They have accumulated money. And rather than hate them or be envious of those people, we should be respectful and go, hey, however you did that, I'd like to do the same, to be a good steward of what you have been given. All right. Finally, investing in a raging bull or bear market. Which one should you be investing in? A bull or a bear market? Both. Both in and out, y'all, in and out. Don't be pulling out of your money and going, oh, we're in a bear market. That's when you buy more. In a bull market, that's when you sell off a little bit. But the best thing is the dollar cost averaging into those. And we'll talk more about dollar cost averaging. Okay. Now, last thing I wanted to do, Katie, this is what you were really here for class today about. I wanted to show you guys how to be smarter than a CNBC analyst. You ready for this? So let's look at the SPX, which is the S&P 500. Okay. So you get called, right? They call you and they say, we kind of like to know what the price, it's the beginning of 2023. We kind of like to know what you think the price of SPX is going to be by the end of 2023. All right. So let me just ask someone today. You ready? Katie, I'm going to ask on you. We'll pick on you since you were the one that really wanted this. Katie, thank you for joining us here on CNBC. We're treating a lot of market participants to tell us what their opinion is on the closing of SPX for the end of 2023. What's your prediction?
As far as where it's going to close?
Yes. Where do you think it's going to close by the end of 2023?
A little bit higher than where it is now. Good Lord willing.
Give me a number.
4,150.
4,150. Okay. Let's go to the option chain. Now, y'all, this is why I'm so big on options, okay? Because I want to show you this. This is so cool. This is what we call an options chain. These are the expirations of the options. Do you know that there are options that expire in December of 2023? Look at this. That's about as close as I could get it. The current price of SPX is what? 4,014. So let's just write that down. Let's pretend that's a static number. Katie, here's how you're going to be smarter than anybody on CNBC. 4,014. When I go to this expiration, December 29, I look over here, that's 339 days from now. Do you see this little number over here that says 637.31? This is the expected move based on the price action in SPX options. Ladies and gentlemen, there is a 68% probability. How do I get 68% probability? That's one standard deviation that the SPX will close up or down $637.31. Isn't that beautiful? Isn't that gorgeous? So we could be at 4,014 plus 637. That's the high range, 4,651 to whatever 4,014 is, minus the 637. And within a 68% probability, that's going to be between the 3,300 and the whatever. Now you know that you can, and you can do that in Thinkorswim too, that you downloaded, right? You can look up any option and figure out, or look up any expiration and tell what the expected move is, plus or minus 637. Now, this number will be different tomorrow, probably by a little bit, and it's all based on the implied volatility. And we'll talk about that more, but I just want to give you a cursory look at how you're going to be smarter than any person out there. Now, Katie, what number did you tell me? You said 4150. Okay. So what's this? 4150. And this is in the December option, 4150. Let's look at the 4150 strike. This is where Katie thinks that the market is going to end. And I can tell you that there is a 45% probability. Listen again. There is a 45% probability that the price, the current price of SPX, will be at or above 4150 in the 339 days. And this is called the probability, or the percent in the money percentage. Okay. Everybody with me? Based on current option pricing, there is a 45% probability that the SPX will be at or above 4150. I hate to tell you, Katie, but there's a 55% probability that it won't. It's the inverse, right? So kind of cool, right? That you can see that the options tell you a story. Now, Katie, what if the question is this? What is the probability that we will touch 4150 within 339 days? I'm going to give you a back of the envelope equation, and then I'm going to show you how to do it. There is approximately, I don't know, there's approximately a 90 or above % chance that we're going to touch 4150 before the end of the year. Now, I like that, Katie, right? How do I know that? I basically take twice the delta. So the delta is 53. Delta approximates the probability of being in the money. So twice your delta, or twice your probability of being in the money, gives you the probability of touch. Check this out. You can go here and you can actually go to the touch percentage. There is an 87% probability based on the current options pricing model that the market will touch 4150 by the end of the year. Now, if you want to study the formula on how they determine this, you can do a lot of studying on the Black-Scholes options pricing model. That may be something that you want to throw up on the exam, that you'll say, well, based on the Black-Scholes options pricing model, we can determine the probability of price closing at such value or touching such value by the expiration of the option. So now check this out. And this is going to be one of your assignments, okay? I'm just showing you how to do it today. What if I came to you and I said, Shannon, Here we are in January. What is the probability that we touch 4150 by the end of the month? I pull out the January 31 options. I go over here to the call section and I say, what is the probability that we touch 4150 by the end of the month? Check it out. 16%. You are now smarter than a CNBC host. When they ask you these questions, you know the answer because you now think in probabilities. That's all this course is about. You are supposed to, I want you to start thinking in probabilities. What is the probability you're going to retire a millionaire by the time you're 51 years old? What is the probability you're going to retire a millionaire by the time you're 65 years old? What is the probability that you're going to have a wonderful day today? I want you to start thinking in probabilities. So now, what if I said, what is the probability that we close above 4150? I go to the in the money probability that we close, oh, let me fly back in. What is the probability that we close at or above 4150? 3% probability. So if all of a sudden we bring you on to CNBC and there's a panel discussion, hey, who's that? Katie, who's that?
I'm
Who's that?
sorry. This is Sharon, everybody.
Hey, Sharon. Sharon, what's the probability that the S&P 500 closes above 4150 by the end of the month? 4%.
Really low.
4%.
I'm so sorry.
No. Isn't that cool though? Y'all, all of a sudden, what if you get on there and you have another expert that says, well, let me tell you where we're going, Chuck. I believe that the S&P 500 is going to close above 4,150 by the end of the month. What do you now tell them, Katie? You're full of hog turds, right? There's only a 4% probability of that happen. And by the way, Mr. CNBC analyst, I'll bet you $1,000 on it. Would you rather be on the 96% probability of being right or the 4% probability of being right? Ladies and gentlemen, you may have to watch this video just a couple of times, but if you will, this gives you incredible knowledge and power to know what is going to happen with option prices based on the Black-Scholes option model. By the way, they won a Nobel Prize for in economics. It's really, really accurate, and you'll be surprised that these probabilities play out so many times, over and over and over and over again. What is the probability that we're going to close under 39.20 at or under 12%? What's the probability we're going to touch that? Probably around 24%. Probability of touch, 25%. I told you, back of the envelope, twice the percentage of being in the money gives you the probability to touch. Ladies and gentlemen, any questions on how you can be smarter than a CNBC analyst? And guess what? I watch it all the time. Guess how many people are this smart on CNBC? Nobody. All of these yahoos that they bring on with all these, hey, I'll tell you, we're going to 5,000 by the end of the year, Chuck. You dumb as a box of rocks. There ain't a chance in hell we're going above 5,000 at the end of the year. How do you know? You go to the option chain. You go, 5,000? Well, let's go find it. So we're 397 days, where's it at? Here, 339 days. Here's December 29th. They say we're going above 5,000. Okay. There is a 94% probability that we don't. Probability of being in the money. There's a 6% probability that we go there. I'll bet $1,000 with them every day to be on the 94% probability. Now, what's the probability that we touch that? Isabel, what's the probability that we touch 5,000 by the end of the year? Hit your space bar. I can't hear you.
94%,
No, that we touch it.
6%.
That we touch it. This is closing at or above. in the money. Remember, we're gonna about twice this, right? So you could.
So then
go-
12%.
About 12%. So if I go here and I go probability of touch percentage is about 12%. Remember, I gave you the back of the envelope. So you don't even have to change this. You can just say, well, the probability that we close at 5,000 or above is 6%. Double that to figure out what's the probability that we touch at 12%. And if some Yahoo on CNBC says we're going to 5,000, you challenge them, ladies and gentlemen, and say there's not a chance in heck. And I'll take that 94, 93% probability any day. I'd bet them $1,000. Questions? Questions? Katie, was that worth staying for? That was good, huh? All right, remember, if you only knew what's in store for you, you'd understand the reason why the wait is so long. I will see y'all Thursday.